The 2025-26 Economic Survey issues a stark warning. The global economy is teetering on a crisis that could eclipse 2008. Between high U.S. tariffs and the aggressive weaponization of global finance, international trade is rapidly freezing up. Despite this chaos, India's medium-term growth forecast has been upgraded to an optimistic 7%. But underneath that top-line number is a profound vulnerability. The country remains exposed to three specific external risks: an over-reliance on the U.S. dollar, dependency on vulnerable Western trade routes, and a critical need for Chinese minerals to power its tech sector. To survive this volatility, New Delhi is executing an aggressive decoupling strategy. They are actively building a multi-front defense system to secure their own supply chains. Think of it as an economic fortress, a comprehensive blueprint designed to insulate India's economic rise from the fallout of global superpower conflicts. The first pillar of this fortress is the currency front. India is executing a quiet, strategic shift away from the U.S. dollar. The Reserve Bank of India has deliberately lowered its holdings of U.S. government bonds, bringing its treasury exposure down to $186.5 billion. Instead of dollars, the central bank is pivoting into hard assets. With global gold prices crossing the historic $5,000 per ounce mark, India is buying at record volume. This chart illustrates the scale of that accumulation. Physical gold now accounts for 17% of India's total foreign exchange reserves. But physical assets are only half the equation. On the technological side, India used the 2026 BRIC Summit to push for linking central bank digital currencies, essentially digital versions of sovereign money. By holding vast reserves of physical gold and routing international trade through digital currencies, India builds a sovereign buffer. This creates a framework that functions alongside the dollar-based order, mitigating the risk of financial sanctions or sudden exclusion from global networks. The second pillar requires rewiring physical trade. India's new foreign trade policy mandates a strategic pivot towards Eastern and European markets to reduce reliance on the U.S. In Europe, this means securing access to two of the world's largest consumer markets. India recently implemented the Comprehensive Economic and Trade Agreement with the UK and finalized a landmark free trade agreement with the European Union. Simultaneously, New Delhi expanded its comprehensive strategic partnership with the UAE, aiming to double bilateral trade to $200 billion by 2032. The partnership extends to infrastructure. The two nations have digitally integrated India's UPI with the UAE's Aani payment system, allowing them to settle trade directly in local rupees. This aggressive market diversification rewires India's physical supply chains, ensuring that a single regional conflict cannot halt the flow of Indian exports. Financial and trade independence mean nothing if a country cannot control the underlying technological supply chain. This brings us to the third pillar, the hardware front. To secure its access to next-generation tech, India has made a strategic move to join the Pax Silica alliance alongside the US and Japan. The core objective of Pax Silica is direct: break China's absolute monopoly on the 17 critical rare earth minerals required to manufacture semiconductors and train AI models. While India leverages international alliances for raw materials, it is aggressively pursuing self-reliance in defense manufacturing, highlighted by the DRDO's deployment of a long-range anti-ship hypersonic missile. Securing these physical technology and defense assets forms the structural core of the fortress, providing the self-reliance needed to resist foreign policy coercion. But building a fortress comes at a steep cost. The Economic Survey reveals a critical complication. While the external walls are formidable, the internal fiscal foundation is under strain. Look at this survey excerpt. The union government is consolidating debt to hit a 3% fiscal deficit target, maintaining credit rating trust. However, state governments are undercutting this, surging market borrowing through state development loans to fund cash transfer schemes. High internal borrowing distorts the sovereign yield curve. Essentially, the demand for government loans keeps bond yields inflated, which directly stalls the RBI's ability to lower interest rates for consumers. India shifted from a rule taker in a US-led order to an architect of its multi-aligned future. Yet, the success of Brand India will be decided not by external geopolitics, but by its ability to resolve these internal fiscal contradictions.